Operations Update conference call. I would now like to turn the meeting over to Mr. Keith Hill, President and CEO. Please go ahead, Mr. Hill.
Good morning, afternoon, wherever you are. Welcome once again to Africa Oil conference call. I do want to introduce, I've got with me Nick Walker, our Chief Operating Officer, and Paul Martinez, our Vice President of Exploration. So, the primary thing is to go kind of the results that were released today and talk about the appraisal wells and the Appear exploration well. But I do think it's worth saying a few words up front. I've just come back from 10 days on the road, meeting with a lot of investment banks and investors and in the new world oil price environment, and I thought it would be interesting to just say a few things regarding that. I have to say almost every one of my meetings, we spend about half the time talking about oil price, about a quarter of the time talking about Africa Oil's balance sheet and funding, and only about 15 minutes talking about kind of the other factors of the company. So I guess no one is an oil price expert, but I've talked to about 40 of them in the last 10 days, and I think I can encapsulate saying that one of the biggest concerns right now is that no one really knows if we've hit bottom yet. And I think the sector is going to be turbulent until such time as somebody feels the bottom and where the lowest price is going to be. I would say that almost to a person, everyone believes that oil prices will recover and will recover to some level significantly above where it is today. But not many people think it may go back to 100 very quickly. I think the consensus is the Saudis have learned that $100 oil starts introducing too many guys to the party, including the shale guys and the deep water guys. And I think a lot of people that I've talked to are talking $75 to $80 as a long-term price range, which is actually quite good for us. I mean, we are one of the lowest cost operators, developers out there with very good contract terms. So, we will be able to withstand a protracted oil price at today's level, and our project will have much more robust economics than most of the projects in the world. So I think one of the real questions, of course, is how long is this going to last? And there you have opinions anywhere from a few weeks to a few years. But I think the consensus is from the people I've talked to is they expect bottoming in the second quarter, controlled by supply, getting rid of the supply, starting to recover in the third quarter, and by the end of the year, kind of seeing whatever that new longer-term price is. So I think with that, I don't pretend to be an oil expert, but oil price expert. In fact, I know that one thing we all know about oil prices is that we're going to be wrong. I did not talk to one person who actually saw this coming. So I think, at the end of the day, it is just a variable we're going to have to deal with. But once again, I think Africa Oil is in a good place. Not only do we have robust economics and very low costs, but we are debt-free, and pretty much all of our budget for 2015 is discretionary spend. We have only one obligation well outstanding on our main licenses, and I think we're now working very closely with our partners, Tullow, to put together a reasonable budget that accomplishes what we want to accomplish, but kind of reflects the new pricing environment. So I think the focus here going forward, we are going to have to defer some of our more expensive, higher risk basin opening wells until next year. Not that we're not still very enthusiastic about it. I think it just comes down to in this price environment, trying to get the best bang for our buck for money we spend. And I think we will be focusing on moving the Lokochar Basin project forward in terms of resource certainty, reservoir certainty, working with the governments of both Uganda and Kenya on trying to get a pipeline solution sooner than later, and really getting towards the end of the year where we think we'll be in a position to file a field development plan with the Kenyan government. So that's the real goals for this year, and of course one of the biggest things we can do to achieve that is the appraisal wells that we have been drilling. I'd say that's the best news in the release is that we've drilled 3 more wells kind of in our 2 core fields, Gami and Amasing, and all 3 of them have come out with very nice thick pay sections. The pressure they all seem to be in pressure communication within the reservoirs that where the wells share common fault blocks. It's also, now that we have the 3D seismic, I think we had a very good structural fit from the prediction of where the wells are coming in, where they actually came in. So I think quite encouraged by the appraisal drilling, and I think giving us more and more certainty that not only we do have a good economic commercial project, but that there's a good chance it will grow as we continue to get data. The other thing we are is getting reservoir information and production information. So the extended well test in Amosing has commenced, and we're in deep planning stages for the Gamia extended well test. We think that's going to be a very important thing to give us much better certainty and a much lower range of recovery factors going forward. And we also have 1,100 meters of core that we're doing an extensive analysis, and again, that will be a very useful hard data to help us calibrate the logs and to give us confidence on the reservoir performance. I'd say the more negative one was the basin opener. We were hoping to find a big oil field up here. We did see some things that are quite interesting. We did see some good shows. In the upper Pliocene, we saw what looked like some good reservoirs, and even into the upper Miocene, we saw some good-looking reservoirs. However, the shows were not associated with those reservoirs. We do think we may have a trap problem. We did have a very thick volcanic section, which is now in a couple of wells we've seen thick volcanics. So I think that is going to be a risk going forward. But I'd say in general we're encouraged by what we've seen in the Cario Basin, that the shows there do point to an active source rock, which is the primary risk of all of these new basin opening wells. So we are drilling on Ngomo now, and we expect that to be finished sometime in late February to early March. After that, we're still finalizing the forward plan for drilling. So sometime in February, we should be coming back to the market with a fully agreed budget, work program budget that we've agreed with our partners and with the host government, and also with a more detailed drilling schedule. But I would say that Tullow and ourselves seem very well aligned on this. We both know these are tough times, and we have to make sure that we spend our dollars wisely. So I think there's a lot of good, constructive dialogue going on between us to try to find the things we can spend money on that bring the most value. And then I guess the last point, of course, which everyone will ask about is, how is our balance sheet? We still have, as I think we've stated all along, that the cash in hand sees us till about the middle of the year, and a lot of the spending that we're talking about is going to be front-end loaded. So really the question is, what are we planning to do the second half of the year, which we would have to have additional funds to do. We do have a number of options we're pursuing. We're still talking with potential partners of coming in and farming into the block. We have had some conversation about merging with some companies that have cash flow, but would like some development upside, and I think we'll continue to pursue those. We have strong shareholder support, not only from the Lundin family, but a lot of our major shareholders. So I think there's not a real question of can we raise money really at this price and these levels. Should we be raising money and making sure that if any dollars we do raise in the future would go to creating value in the company, given that they're about 3 times more expensive than they were last time. So with that as a backdrop, I think we'll go ahead and turn back to the moderator, and we can start fielding questions from the audience.
Thank you. We will now take questions from the telephone lines. If you have a question and you're using a speakerphone, please lift your handset before making your selection. If you have a question, please press *1 on your telephone keypad. If at any time you wish to cancel your question, please press the # sign. Please press *1 at this time if you have a question. There will be a brief pause while the participants register. Thank you for your patience.
Yeah, I might also point out that we do have our most current corporate presentation on our website, January 2015. So some questions we may be referring back to some of the slides in that presentation if people are at computers and can pull that up.
The first question is from Michael Alsford from Citigroup. Please go ahead.
Yeah, thanks for taking my question. Hi, Keith. A couple of questions, just really to get a bit more colour on the funding. What is the capex budget for 2015? Can you give some phasing as to, I guess you're exiting, exited 14 with probably about $180 million worth of cash. So could you give me a sense of what is the capex for 15 and what is the funding shortfall into the end of the year that you need to meet? And then just more broadly, just to give a bit more colour on the operational, events over the next 3 to 6 months. I guess for me, clearly a key uncertainty, and I guess one thing to firm up is recovery rates on the Lokochar area. So could you just maybe talk us through when we might get more data points around the, extended well tests and other operational activities that you're carrying out in that area, please? Thanks.
Yeah, I'm afraid I'm going to have to be a little vague on budgets and cash position because we haven't finished our year-end financials. So I think the extrapolate, probably the best thing you can do is extrapolate from our third quarter financials. But and then the budget, we haven't agreed a budget with Tullow yet. The real discretionary spend going forward is going to be continuing to drill. We have in the past, had a 70 to 80% of our budget has been for drilling, and that still will be a fairly major component. So that's the real thing we're working with our partners to, what wells do we want to drill, how many rigs do we want to keep. So I think we've already released 2 rigs, or in the process of releasing 2 rigs, and I think the idea is we go down to 1 rig, and even would have the opportunity to go down to 0 rigs towards the end of the year. But I think what we're really trying to focus on is wells that create value and wells that we think are worth financing. So I can't really answer your question of how much money we need to see us to the end of the year. It could be fairly small if we elect to have a reduced budget, or it could be a bit bigger if we plan to keep drilling, and we haven't made that decision yet. As far as the reservoir and moving that forward, maybe I'll turn over to Nick Walker, and he can say a few words about the extended well tests and the core analysis program, which is the 2 things we really think are going to be the biggest drivers for moving our reservoir certainty forward.
Yeah, Michael. The first thing is, it was in our press release. We're going to be conducting an extended well test at Amersing, which will involve 6 zones completed in 2 wells, so Amersing 1 and Amersing 2A. And we're just in the final throes of completing the second of those wells. So later in January, we'll start cleaning them up, and then we'll start to see data in the second quarter, through first quarter and second quarter from the Amersing extended well test. And I think that'll be a good measure of connectivity and productivity, and will be one set of data that will help us sort of home in on recovery factors. The other thing is that we're going to do a more extensive extended well test at Ingamia, which will involve 3 wells, and we're still working on the exact design of that, but we're going to go and start completing those wells again in the first quarter, and we should start to see results coming out of the Ingamia extended well tests, around mid-year. The other thing that we've got going is we've now cut 1,100 meters of whole core, and we have an extensive core program going on that will help not only understand the petrophysics better and the oil saturation in the rock, but also the flow dynamics of that rock with some relative permeability analysis. And again, we're going to start seeing results of that through first quarter into second quarter. And I think that, combined with the appraisal program and of course the 3D seismic we've got now, will give us a lot better subsurface picture across the discovered resources, and we'll be able to combine all of that, and hopefully around mid-year and into third quarter, we'll start to get a much better understanding of the range of not just reserves but also recovery factors that we potentially see in these fields.
Okay, and I guess, Nick, just to follow up on that, I'm assuming, will you be able to sort of be incorporating that into a reserve report mid-year, or do you think that's a sort of a longer-term plan?
Yeah, I think it'd probably be closer sometime third quarter. I think we want to see, and it'll be kind of a gauge of how much work we're doing, in the third and fourth quarters, and kind of, how the results are, it will take a little time to get the results of the extended well tests, and a lot of this core analysis does take some time as well. So I think once we have kind of a preponderance of data that we think is going to give us a high level of certainty on reserves, I think we'll pull the trigger on the resource report then. But my guess would be sometime in the third quarter.
Okay. Thanks, Keith. Thanks, Nick.
Thank you. The next question is from Shaheen Amini from TD Securities. Please go ahead.
Hello, Keith, Nick, and Paul. Couple of follow-on questions, please, from the earlier points. First one, can you confirm what was your cash position at the end of 2014? And also, actually, you mentioned that the volcanics was a bit of an issue for the North Carrier Basin, and bearing in mind that North Turkana is quite a distance away. Do you see that being a risk for Ngoma well, which is going to be your next big catalyst? And finally, on the oil... Sorry, go on.
Yeah, the financial one, we just haven't finished our year-end financials, so I don't think it behooves me to quote a number until those are all consolidated. But I think if you look at our burn rate over the previous quarters, our costs are relatively fixed, so you can extrapolate on your own, and we'll see how that number comes out. But, on the volcanics, these rift basins are subject to volcanism. We saw that in one of the Chubahar wells, the second well in Chubahar, in the very north of the area. There was a fairly thick volcanic section as well. So I think it may not be so much basin specific. The other well we drilled in the Chubahar Basin didn't have nearly as much volcanics. There's in fact fairly modest amounts of volcanics. It may be a very local phenomena within the basin. So hard to predict, not very easy to see on seismic. The two wells we did find volcanics in did not have a lot of reflectivity in that section. But again, like in a pier, it's below the volcanics, so it's hard to tell whether you're just deteriorating the signal below the Pliocene volcanics, or if you're actually seeing effect of the volcanics. But I think that'll be a risk going forward in all the basins. So far, even in the Lokachar, we did have volcanics in several wells, but not nearly as extensive as we've seen in a couple of wells in some of the other basins.
I recall previously, a couple of years ago, you kind of highlighted the North Turkana being the intersection of the Cretaceous and the Tertiary rift, and that it could geologically be very interesting. Is that still sort of the positive points on that area?
Yeah, I think there was a couple of interesting things about that. Number one, the structures seem to be much kind of bigger and robust, and in some cases slightly different looking than the other just pure tertiary basin, particularly in the northern part of the Turkana Basin where that intersection is. So I think from a structural standpoint, it looks quite interesting. There also, in outcrop, there is a very thick basal Cretaceous sandstone, which you wouldn't expect to see in any of the tertiary rift basins. So that would be the ideal world, is if you've got the thick basal Cretaceous sandstone sitting on these fault blocks that are later sourced by the tertiary. That to us is an interesting proposition. But the prospect we're drilling in Ngoma looks very much like the whole string of pearl prospects and fields in the Lokachar Basin. It's up against the basin-bounding fault. There does seem to be a fairly deep hole to the north, which should be a source kitchen. And one of the real risks is what is even if the source is there, I think that's the most significant risk is there a source? We have a little hint of that basin actually extends up into Ethiopia, where we drilled the Sabisa and Tatule wells, and we did see shows in both of those wells. So once again, we have a hint that there's a source rock there. We also see seeps on the lake, which again gives evidence that there is a working source rock there. So the real unknown is what the stratigraphy is, what the reservoirs will be, what the seals will be. So this is a frontier well. It's really the first well. I think it's about 200 miles in either direction before you run into another well. So this is frontier drilling at its finest, and I think if we walk away with seeing good shows, seeing some good reservoirs and a good sealing lithology, that'll be a victory. Obviously, if we find an oil field, that'll be a bigger victory. But this is a fairly high risk well. But as we've said in the past, this is by far our largest basin. So the potential of this basin from a prospective resource is about 3 times as much as any other basin we've got in the portfolio.
Just one final question, please, on the oil price. I recall Heritage put out the conclusions from an oil marketing study a few years ago when they were looking to sell to ENI. And one of the conclusions was that the crude from Uganda, which is very similar in crude assay to what you've got in Kenya, could actually sell at a premium to Brent. Just interested to know whether you or your partners have done any recent marketing studies to see what's likely market dynamics for your crude out of Kenya.
Yeah, Tullow has done a study, and we do see that it's very nice, light, sweet crude, no sulfur, no metals, no bad stuff. So it will command a premium to Brent most likely. So not a huge premium, but certainly Brent plus a little is what we're thinking now. So the only thing it has is wax, which again, if you keep the crude hot, most refineries don't have any issue with wax, and we think it's going to be a very desirable crude, particularly for the Asian refineries.
That's very helpful. Thank you.
Thank you. The next question is from Dan Eckstein from UBS. Please go ahead.
Thanks. First question, what's your year-end net cash balance and what's your budget for next year? Only joking.
Okay.
I'm only joking. The first question I've got is, the appraisal wells that you drilled today were quite significant step-outs, sort of 500 meters to a kilometer from the discovery wells. In terms of step-out, could you tell us how that relates to the Gaffney-Klein 2C range in terms of areal extent and or the net pay versus prognosis within the CPR?
Yeah, it's slightly hard to quantify. Each one is a little bit different. Certainly by stepping out and proving more areas, we would expect to see a shift in from prospective resources into contingent resource. Now, how much that is, will be up to the reserve auditors. But these are definitely positive wells, and we'd expect to see some increases in that. The well we're just going to be drilling next, the Gamia 7, is actually even more of a step out. It's actually stepping out into a new lobe that we've seen in the 3D that was never tested before. So that one will be one of the bigger ones for adding pure contingent resource. But I think there's another facet to it, that by drilling these wells and showing the continuity of these reservoirs and the fact that they have pressure continuity over big distances, I think that gives also a lot of credence to the estimation of recovery factors. Now that we've proved that there's good quality reservoirs distributed over the structure, that pressure communication, I think where there have been conservative assumptions in some cases on the recovery factors, that will help us put them over the edge to be a little more aggressive. But you really need to combine that with the extended well tests and with the core data. So we're hoping all three of those factors together, raise that recovery factor. So the other thing is the range of recovery factors. If you look in our presentation, the range given by our reserve auditors all the way from 16 to 35%, which is a huge range. And the upper part of that range is almost double what the lower part of that range is as far as overall recoveries. So, we'd like to tighten that up a bit too. See that range tighten up and raise is the real goal for the program we've got this year.
Okay, thank you. Then second question, probably the best result in terms of reservoir deliverability was with Twiga 2A, which looked to have hit a bit of a sort of sweet spot in terms of some kind of storm or turbidite deposits. What's the outlook in terms of chasing that across the basin in 2015? Is that going to be a focus, or is that something that we might have to wait for in 2016?
I think we are considering drilling another well at Twiga. It's on the potential wells to be drilled this year that we still need to agree with our partners. But before that, we're going to be drilling the Acales Deep. So the one thing, and again, it's in our presentation, is with the new 3D, we think we can map this rift basin edge facies. If you recall in Acales is one of the prospects we quite like. It's right between Twiga and Gamia. We thought it was one of the best defined structures. We drilled into it, and we only had about 30 meters of net pay, so it was a bit disappointing that we didn't have the pay thickness that we had in some of the other fields. Now, when we got the 3D, we could see that, and when we drilled, the well we drilled actually went into that rift basin edge facies. Now with the 3D, we can kind of understand the distribution of that. So the Acales Deep is going to be one of those tests that go, in the original Acales well, it did see a very good section of reservoir just above that basin edge facies. In fact, the single best core that we've got so far, the one that we show a picture of it on our core analysis page, 13 Darcy's of permeability, was actually in that well. So we're going to be stepping down dip from there and trying to follow that better reservoir. Hopefully, if we can stay away from that rift basin edge facies, we can see the thicker, cleaner sands down dip. Just what we're seeing in our development drilling, appraisal drilling down in the south is, as we move away from the fault, we generally get thicker, better quality reservoirs. And we will take that well down and actually into the Lacone Shale and see some of those sands that you were mentioning in the Lacone Shale, which, again, there's a whole page devoted in our presentation to that. We think these sands are quite interesting, even though they're relatively thin, 3 to 5 meters thick. They're encased in source rock, so we think there could be a sort of unconventional type play where these sands may be draining the actively generating source rocks around them. So I think we'll take a look at the Acales well. That well is up next. So basically, the Appear drilling. I think they released the rig today, and that rig will be moving to Acales Deep. And I think if the results of the Acales Deep are as good as we think, I think that's going to give us more ammunition to go up to Twiga and do the same thing at Twiga.
Thank you. And just one final question. Where or has there been any sort of progress in your discussions with the Kenyan government regarding capital gains taxation? I mean, is there a discussion to be had there, or are things pretty much set in stone, do you think?
I think there has been a lot of progress, and I mean, if you read the Kenyan papers, there are a lot of proponents in the Kenyan government, led by the Cabinet Secretary of Energy, who are concerned that tax is going to decrease direct foreign investment, and they are planning to hold a bid round this year. And obviously, in the low oil price environment, it's doubly vexing that I think there is a lot of momentum to talk about a reduction or a even removal of that tax. But it will have to go through the process, and obviously it'll have to be seen as the best interest of Kenya, not necessarily best interest of us oil companies. But I do think there's a groundswell that people have realized that rate was significantly higher than what should be acceptable to industry, and that they see that, particularly in today's price environment, that it's going to be a difficult thing to bring new investment and to even keep investment in the country. So I'm hopeful that the mechanism will likely be the Finance Bill of 2015, which generally is presented to Parliament around June and was passed this year in September. And I'm hopeful that there'll be a significant reduction in the capital gains at that time. I mean, oil prices aren't 100% bad news. It does give you the ability to go to host governments and discuss terms. It also gives you the ability to go to service contract about price reductions, and it also is an opportunity to kind of look at reorganizing yourselves and look about cost cutting within your own organization, which, of course, our partner Tullow has already publicly announced that they're in the process of.
Cool. All right. Thanks.
Thank you. The next question is from David Dudlike from Dundee Capital Markets. Please go ahead.
Yes, hello to you all. I'd like to, if I may, just clarify your answer to Dan's first question regarding contingent resource areas. If we just focus on Gamia for a second, given that 5 and 6 were in the same fault block as Gamia 3, should I assume that those wells by location may have been captured by, if not the 2C, the 3C area? And the follow-on to that would be, again, if I look at the net pay that you encountered, again, just to clarify my understanding, where do those sit with respect to the assumptions that would have been made within the last resource report? And the same question speaks to Amosing 3 on the Amosing field.
Nick, you wanna field that one?
Sure. I mean, I think yes, they were in the same fault block, and we have resources in our existing resource base associated with those areas of the field. But what we're doing by drilling further wells, we are reducing the level of uncertainty. So we're demonstrating that we have net pay at that point, which we had only mapped previously, and we've got oil there. So what we're doing is narrowing the range. So we have a spread of, in our basin of 300 1C to 1.3 billion barrels 3C, and what we're moving here is resource from the more risky categories of 3C into 2C with each of these wells. So and also into 1C. So we will be moving resource through the range of categories. Now, none of these wells bring prospective in because they were all drilled within the contingent discovered resource areas. But some of the follow-on wells are going to move prospective into contingent as well. So, for example, the next well on Ngamia in the map and the presentation is on Pad F. That's on this lobe that Keith described out to the east. That is not in our contingent resource base. That if that works, and that comes in with oil at that location, then we'll see a prospective move into contingent.
Okay, no, that's great. That clarifies it, and kind of backs up my assumption that 7 was probably going to be the only one that brought in prospectively new contingent resource. Okay. Moving
you would expect them, David, you should expect them to grow the 1C and 2C numbers.
Oh, absolutely. Yeah, absolutely. No, I get that. Moving to the other side of the equation, the basin openers, whilst you have historically provided prospective scale on various wells, such as the Epir well, I can't seem to locate any such estimates for Ngoma nor indeed the forward plan North Samaki and indeed Lekep. Are any of those numbers out there in the public domain? And if they are, could you...
those prospects didn't exist the last time we did prospect evaluation with Gaffney Clan. So this year, we only updated the resources on the 7 main fields. We didn't update all of the exploration prospective resources. So these are new prospects, and therefore we have no third-party numbers. And we generally don't put our own numbers out. We generally only put third-party numbers there. So. it's very hard to say what those fields could be because you're really making such a guess at the thickness and quality of the reservoir. Literally, these prospects are around the same size as a Gamia, Twiga, Amosing field. But if you go from 10 meters of reservoir to 200 meters of reservoir, you go from a fairly small field to a fairly large field. So I think even when we drilled Gamia, the first well, we had expected 25 meters of reservoir was our most likely case, and we found 200 plus. So I'm not sure those numbers are all that helpful, really, because there's such a wide range of uncertainty in any possible reservoirs that we might encounter.
Okay, thank you.
They're roughly the same size aerially as the Lokichar Basin fields.
Okay, now follow on. You've danced around the capital budget for obvious reasons, since you're still working that through with your partner. Let's perhaps approach it another way, and perhaps Nick, you can come in on this and just speak to the expected AFE costs of your appraisal well program. I know there are a couple left, 7 and Amosing 4 that are shown as firm, and perhaps give me an indication as to what your expected costs are for the 2 EWTs. They are, as you said earlier, that they're different in concept or in scale, and also the AFEs for the firm basin openers. So at least from a bottom-up basis, we can go away and decide, well, okay, these are the costs, and we'll just have to see where you guys end up cutting the costs.
Sure. Do you want me to do that, Keith?
Yeah, go ahead.
So, I mean, where we've got to, Tullow have done a good job at driving down costs in the drilling program in Kenya. Where we've got to on appraisal wells within the Lokichar Basin is sort of $12 to $14 million for a well within the sort of existing depth range that we've been drilling, sort of 2,500 meters. So that's the sort of order of magnitude there. In terms of the new basin wells, you should expect sort of $25 million-ish, depending on the location. Some of them have been 20, but 25 is not a bad number, given if there's a long mobilization and some civils to go with it. And then in terms of extended well test, actually we spent quite a bit of money in 2014, so all the completion equipment, the perforating equipment, and a lot of the surface equipment has actually been purchased already. So going forward, we've got the completion of the wells. Some of that started last year, and we've got the sort of operating costs associated with running it. So, the split between the 2 years I don't actually have. Completion costs about $12 million to complete a well, but some of that money was spent last year on some of the equipment. I don't have the break between the 2 years.
But I mean, in terms of the actual facilities and everything, those costs have, for the large part, already been expended.
Yeah, I would say about 50% of the extended well test costs have probably been spent last year.
Of course, we've drilled all the wells, so that's the big cost.
Okay, and ballpark, notwithstanding the fact that some of the costs have already been spent, what were your AFEs for? I mean, what was the overall cost for this test program?
Well, for the 2 EWTs, including all the completion equipment, all the surface equipment, is about, excluding the drilling of the original wells, is about $80-odd million, of which I would say half of has been spent last year.
Okay, no, that's very helpful. That's all I've got for the moment. Thank you all very much.
Thanks, David.
Thank you. The next question is from Emerson Cooper, a private investor. Please go ahead.
Oh, Keith.
Yes, how are you?
Not too bad. I'm wondering, was there 3D seismic at Akossawan? And I'm wondering why it wasn't sidetracked or another well drilled, because as far as I'm concerned, I think this is probably the most prospective area of the works. And if it's connected in any way, shape, or form in pressure to Amosing, it could be a big thing.
You're 100% right on. I mean, we did have 3D seismic when we drilled it. It was the first batch of 3D seismic that we got processed, and I would say it wasn't quite the final processing. When we drilled the Kosovan, of course, the attraction of that is that it's directly up dip from Amasing, with no real barriers in between. We can't see any faulting. We can't see any big stratigraphic differences. In fact, we drilled the Kosovan. We were all jumping up and down for joy. We thought we'd found a massive big oil field there because we found a very thick sand section that was filled with oil. But we were quickly brought to earth when we ran the logs, and we saw that the porosity was only in the 3 to 5% range and not non-reservoir. So, between Amasing and the Kosovan is a huge area. As far as if we could prove up even half of that area, it's probably the largest thing in the Lokachar Basin still to prove. So you'll see on the map there, we've got a well-planned Amasing 4, which is where we're going to be drilling on the other side from where we were at Amasing 3 and starting to step up there. I think the idea is, you'll also see on that map there was an Kosovan down dip location. The problem is we don't really know how far down dip we have to go. So I think the idea is, rather than really aggressively step out and possibly drill another well that is tightly cemented, the Amasing 4 will give us a little confidence, and there's even a dot on the map, I believe, in the presentation, that moving again as far away again. I think that's the idea, is we kind of step away from Amasing and just see how the reservoir develops until we get confidence that we can move a more significant distance. Each one of those wells will be proving up additional resources that we can add into the equation. But I'm with you. Until we go drill those wells, I think there's the potential for a very large accumulation between Amasing and a Kosovan, and that this tight facies may actually be the up-dip seal. The reason we didn't sidetrack at the time is we just don't know how far down dip it is. And I think the idea of go where we know the good reservoir is and just start moving up dip is probably more prudent.
Could you give me some idea when you're going to drill a Amasing 4?
Yeah, it's on as a firm well on our schedule, but I'd have to say our schedule is still being agreed with Tullow. I mean, Nick, maybe you want to chime in. I think we both like that well, and I believe it will be a firm well, and it will be drilled in the first half of the year. But
I'd say the first half of the year, it's one of the ones that's definitely going to get done. We've built the surface location, or largely built it, so I think us and Tullow agreed that it's a good well to drill, and I think it's right up there as one of the early ones to be drilled.
Okay, gentlemen, thank you very much.
Thank you.
Thank you. The next question is from Al Stanton from RBC. Please go ahead.
Yes, hi guys. 2 questions. The first question is, can you give us any sort of roadmap with respect to the pipeline, and whether we should be expecting any progress reports through Q1 or the first half?
Yeah, I mean, well, Nick, maybe you handle this one.
Yeah, I mean, there is a slide in our pack that sort of gives some high-level comments, but what I'll say is that both governments, Uganda, Kenya government, agreed on a joint pipeline. The 2 joint venture groups, Uganda joint venture with Tullow, Total, CNOOC, and ourselves in Kenya, we're aligned in trying to do it together, and in fact we're having regular meetings and we're working with both governments jointly. The governments have appointed a technical advisor to go and give them advice on which route and the sort of structure that we should be looking at. There are really 2 routes in consideration. One is the sort of Lapset route, and then there's a southern route that runs along the existing right-of-way associated with the existing products line down to Mombasa, and both routes are being, I think, considered by government. And what I think you should expect is, I mean, what we feel is increasing momentum to move this forward. and what we expect is that in the first half of this year that we'll see some progress on this. What we want to see is agreement on a route and agreement on a commercial structure, which will then give us the basis to start to go and do FEED engineering. And so, I think we feel very confident that we're seeing momentum building in government to resolve this and move it forward. And as I say, both partnerships are aligned, which is a great place to be. It feels like it's moving to me.
Thank you. And the second question, Keith, you mentioned you were having, considering merger discussions with peers. So should we be thinking, Africa and the Middle East, say Egypt, or do we have to use our imagination a bit more and maybe look to Colombia or Asia? Is there any guidance on what Africa oil would look to merge with?
Certainly a geographic focus would be preferable, but I would say it's not exclusive. I think at the end of the day, we're looking at all different options, and one of the biggest variables will be dilution. In this environment, no matter what you do, if you do a merger, there's potential dilution there. If you do a farm out, that's another way of diluting, and then if you do an equity raise, that's a third way of diluting. Obviously, the equity raise looks a bit more dilutive than the others at this point because of our share price and because of oil prices. But I think whatever we do, we will need to look at basically what dilution would occur to Africa Oil shareholders. I think in the merger case, there are a number of companies out there that have production and cash flow. There's companies that are trading just about at their cash or below their cash, and they're equally damaged. And I think even though it's difficult to do a merger in this price environment, I think if you can put two companies together and basically solve our shorter-term funding problem and give them the growth they need, I think it still makes sense. So I think the idea now is let's pursue all options and see what's best for the shareholders.
Okay, cool. Thank you.
Thank you. The next question is from Peter Kemp from Energy Intelligence. Please go ahead.
Oh, hello, Keith. I was just in your state. Partially answered the question earlier on capital gains tax, but I was wondering if you could just give a little bit more detail on what the current situation is. You say in your earlier statement that you want to resolve the remaining tax and fiscal issues in the new pricing environment. What is your understanding of the tax burden on you if you do a farm-out transaction? I've seen estimates of a 30% tax going up to a 37.5% tax. Could you give any clear indication of what your current understanding of your exposure is?
I think it's fairly clear in the new legislation that farm-outs would not be subject to capital gains tax, as long as you're not recovering more funds than what you have spent. So for any capital gains tax, you're allowed to deduct your prior expenditures for the calculation of capital gains. So in the case of a farm-in, it's also quite clear that any future carries would not be subject to capital gains. So that at current levels, that kind of suggests that the better path would be, if the capital gains tax stays at the current level, your better path would probably be to do a farm out than an outright sale. But as I said, we've met with the government quite a bit. I think that tax was introduced without a lot of engagement, either with other ministries within the government or with the oil industry as a whole, and I think there's a lot of people in the government who are rethinking that, and not just because of the oil price environment, but just because the oil industry in Kenya is in its infancy. I think the last thing you want to do is really put an onerous tax on it and discourage investment before it even starts to grow. So again, I can make no promises, but I can tell you that a lot of the bigger, more connected decision makers in Kenya, many of which we and our partners and then the KOGA, which is the Kenyan Oil and Gas Association, have all spoken to, are concerned about this, and I think there is a push to either reduce or eliminate that tax in the coming year.
And in the light of the oil price environment, when your partner Tullow said last week that they plan to, not just in Kenya but across the board with their African properties, renegotiate or attempt to renegotiate their PSCs. Do you have any plans on that front as well?
Yeah, I mean, I would say that every company should take advantage, or not advantage, but every company needs to look at, if there is a new pricing environment that they think is a long-term pricing environment. I think we all need to relook at our economics and make sure that our PSCs justify that. I can say right now that because of our low-cost environment, and the expectation that our expectation, and you look at a 3-year strip of oil prices, that we don't really believe this $50 oil is going to be a long-term thing. Our economics are still relatively robust. But of course, if you start believing in $50 oil for long term, then definitely you need to start engaging with the governments, because the worst thing for both of you, both the host government and the oil companies, is to not have an economic project that meets criteria. And around the world, we compare all different jurisdictions, all different projects, and if they're not competitive, there may be some revisions required.
Finally, on your field development plan, you say also in your statement that you want to finalize that, or you're aiming to finalize that to present to the government by the end of this year. Is that to be based on Ngamia and Amasing, or is it exclusively, or one or both, or is there more to be included in that?
No, it would include Ami and Ngamia are kind of the core fields that we would start the production with, but it would be a modular, scaled-up production, so that we would add fields such as Icalis, Twiga, Agete, and any others we may find or appraise between now and then. So I mean, it will be a bit of a living document. The field development plan is always a place in time. As we get the well data coming in, there are often amendments to it before it's finalized. But I think the important thing that we agree with our partner is we have a document that encapsulates the 90% solution with the data we have in hand, and that ready to submit to the government by the end of the year. Nick, I don't know if you have any comments on that.
No, I mean, I think what we're trying to do is to get to resource certainty by the end of the year, and then get the pipeline structure, commercial and route structure going, so that we can start the detailed engineering. And I think what you should see is that through 2016 that we sort of progress that approval of an FDP during that year so that we can start a sanctioned project development, in 16-ish.
Okay.
That's what we're trying to achieve.
And just one final question, if I may, on the rig count. You said you've released 2 rigs already. You're going down to 1. Is that for Africa Oil Corp, or between you and Tullow? Just 1 between the 2 of you?
Nick?
Yeah, so, I mean, we actually have 4 operating today. One of them is the completion rig at Amasing, which will go very shortly. A second rig, once it's finished Icalis Deep, will go. So at the end of the first quarter, we'll be down to 2 rigs. And the discussions that we've got going on with Tullow around budgets, as I say, are still fluid. But what we're talking about is releasing another one of those rigs in the second quarter. So we would be down to 1 rig, and then we may actually just leave it a bit flexible in terms of keeping a rig going and see where the program goes and where the oil price goes and how much we wish to fund and how much success we have.
Okay, and those 2 would be the PR Marriott 46 and the SMP 106, is that right?
Those are the 2 ones we would keep. The Weatherford and the SMP 5 are the ones that will certainly go. Yeah.
Okay. And if you were down to 1, which one would you be retaining? I mean, the SMP 106 has only just arrived, hasn't it?
Yeah, it's probably more likely that that's going to be the one.
Okay. Fine. Thank you very much, gentlemen.
Thank you. The next question is from Jerry Donnelly from First Energy Capital. Please go ahead.
Gents, thanks for the update today. Just getting back to the CGT, there have been a lot of questions about that. Do you see resolution of a lower CGT rate as a prerequisite for bringing in partners, or indeed progress towards FID, or do you think hold that as a kind of ransom until you see some sort of reduction in CGT? That's the first question. The second thing is the government driving towards some type of early oil scheme, and is this something you'd consider? And then lastly, I think, according to Nick, you held a well testing workshop in late 2014. Would you be looking to implement some of the improvements around well testing in these extended well tests coming up? And what are those improvements? Thanks.
Yeah, maybe I'll address the first two and let Nick have the third. So the first one regarding the CGT, again, for bringing in partners, it's not really an issue, because bringing in partners and doing a farm out, assuming we don't get higher back costs than what we've actually spent, which is not what we envision doing, would be not subject to CGT. Really, the CGT would be more for a corporate sale. If someone wanted to come in and buy the whole company, I think that's going to be one of the things that would limit our ability to do that. So I think what was the second question again, Jerry?
The second question was early oil scheme. Is this something that the government might drive?
We went through that in detail with the government and internally, and unfortunately, because of the requirement for a very lengthy road and to get to the rail, and we'd have to upgrade the rail line, we'd have to bring in heated tanker cars, and we're looking probably at least 2 years and a fairly large amount of expenditure to do that. It just doesn't look economic, and doesn't look like any of those schemes would be economic. So we met with the government, discussed it with them, and I think we all decided it was better to just keep our focus on the long-term solution, which was the export pipeline. In some cases, it's nice, like in places like Kurdistan, where you've got roads and you've got pipelines nearby and you've got a ready market, and you can generate early cash. But here, we wouldn't make any money at it, nor would the government, and we're very concerned it would distract us from our ultimate goal. So, Nick, I'll let you talk about the well testing.
Yeah, I mean, Jerry, obviously we've done quite a lot of well tests now, over 20 in the basin, and we learn, from each one of those, not just from the reservoir side, but operationally what the issues. And, it's fair to say we have learned that wax and the swelling clays, we can create damage in the reservoir. So we've designed our extended well tests and the completions around that to avoid that. We've also learned quite a bit around artificial lift and managing wax in the wellbore. And again, our program is driven to deal with that. So, for example, our early well tests, we had to shut down at night because we get cooling. We'd end up circulating the well out to water, and our extended well test, what we're doing is we're heat tracing the tubing that's in the well so that we keep it warm enough and we can keep the oil mobile. So all of those learnings that we've got out of the DST program we've done, we've incorporated into the well test, the extended well test program. And of course, we've got a long list of things that's detailed in our slide pack of things we're looking to learn out of the extended well test, which will help mature our learning for development of the fields, not just on understanding reservoir quality and connectivity, but also some of the production technology issues that we'll understand out of that as well.
Helpful. Thank you, gents.
Thank you. The next question is from Brendan Warren from BMO Capital Markets. Please go ahead.
Hi, Keith. Hi, Nick. Look, just quick clarification and question on timing, I guess, submission of FDP. It looks to me like things have slid at least 9 months to the right. Am I correct in thinking that you sounded like things are ticking along quite well, but I get the sense things are actually slowing down, and I guess that's the case with a lower oil price and we're still in a $100 cost environment. But are there any, call it, approvals, or do any clocks start ticking once you submit FDP? And do I understand in terms of timing between an FDP and FID, to first oil? Just, are we going to see, call it first oil before the end of this decade?
Nick, you want to handle that one?
Yeah, sure. I mean, I think FDP is not necessarily the milestone you should focus on. I think it's an important milestone, but we've got flexibility about when we do it. The key point is FID. And, what we're targeting is trying to create an opportunity to achieve FID at the end of 2016. Our view is that the risk is actually between now and then. Once you've got FID, we should have defined the project well enough that we can build it, and we're saying a 3-year build cycle. So that would put you to sometime in 19 first oil. I think, actually from my perspective, the critical path to getting to FID is probably around defining the pipeline structure. And as soon as we've decided how the pipeline looks, both from a commercial perspective and route, then we can start the detailed environmental and social impact studies, which probably sit on the critical path. And so if we can resolve these during this year, then we can preserve that schedule. And FDP really, we'd like to try and do it at the end of the year, but it may slip into next year. We're still working out, how much money we want to spend on the engineering this year. It's possible we could have it in next year and still preserve those dates.
Okay. Am I correct in assuming or thinking that we have sort of slipped at least 9 months?
Yeah, well, I think it's fair to say. I mean, we were originally saying sometime in the early part of, the first half of 2016. So, I mean, you're sort of looking at a 6-month-ish delay there.
Okay. All right. Thanks, Nick.
Thank you. The next question is from Julian Beer from SEB. Please go ahead.
Thank you very much. Good afternoon, everyone. Keith, on the pipeline, what entities or which entities are involved in project financing or export financing or what have you? There was discussion last year that the World Bank had become involved, and if they are, how involved have they actually been so far?
No, I think of all the things, and by the way, good to hear your voice, Julian. I was worried you weren't going to be calling in.
Always
I think you missed the last one for the first time, so I'm glad you're back. But I do think the financing of the pipeline is probably one of my lowest levels of concern. There are a number of people who are very keen to come in and finance the pipeline, including some of the big upstream partners, particularly those in Uganda. But the World Bank came out last year and pledged funds for it. We've met with the World Bank and with the IFC and IMF lately, and I think they see this as a very strategic project for the region. And I would guess that they will be very aggressive, trying to be one of the financing entities for that pipeline. So again, I think that's besides the route, the commercial structure of the pipeline. Right now what's being talked about is a pipeline company where upstream partners may have the right but not the obligation to be a participant at the pipeline company, and that there may be other funding organizations who will want to come in and either be an equity partner or to take part in the financing of that pipeline. But pipelines traditionally are one of the easiest things to finance around the world. So I don't think it's a matter of getting it financed. I think it's just getting the right financing partner and getting the best terms that both ourselves and the Kenyan government can get.
Yeah, I guess there is a certain reputation that projects financed with World Bank inclusion are well financed, but they can be bureaucratic leading up to the point of financing. To what extent has the discussion around the financing model been advanced in advance of creating this pipeline company?
Well, I think from the IFC in particular, with the finance, one of the financing arms of the World Bank, they're already in Uganda. They've reviewed that project in detail. So I think one would hope that they would be up the curve a bit on doing that, because you're right that IFC financing, they do have a number of steps that they need to go through from a kind of corporate social responsibility aspect, and sometimes they do take a bit longer, but they also are a very good person to have in the in your financing or shareholder base, because it gives a lot of credibility once the IMF has come in or IFC has come in and completed their due diligence. Then banks and other funding organizations get a lot of confidence around that. So I think both ourselves and the upstream partners and the host governments of both Kenya and Uganda are quite keen to pursue that relationship.
Okay, and then the final question, Keith. When we look at the map, or some of us look at the map, I guess we think, why look for any other route except for the southern route as far away from the Somali border as possible? What are the motivations to actually go afresh and go for the Lapsset route? Who's pushing for that the most?
Well, I think from the upstream partners, the cost difference is not that significant. I think from a pure, if I'm just building a Kenya pipeline, the easiest pipeline route to build is probably actually the northern route. It runs along the Lapsset corridor. It wouldn't be exactly in the Lapsset corridor. But, I think there are a number of other considerations, particularly on the Kenyan side. I think the Lapsset project has been there for a long time, and they see it as an opening up of northern Kenya, and it's really got a social investment component to it. So I think they're keen to build the northern pipeline for that reason. And one of the things they believe is if you build that, prosperity will come and take care of some of the security issues, or help out, I'd say, on some of the security issues on the north. For us, the Lapsset project is really road and rail and power and fiber optics and a number of other things. The pipeline itself, being a buried pipeline, isn't necessarily a critical part of that. I think that's one of the discussions ongoing, is how linked together the pipeline and the Lapsset project should be. So once again, I think that's as an upstream partner, we're happy to go with the host government and their recommendation. For us, it's either route is an acceptable route. It's just the one for our most important thing is that we all decide on a route sooner than later, because basically every day we don't decide on a pipeline route and commercial structure is a day that first oil will be delayed.
Okay, and sorry if the question was asked before, but are there any milestones that we can wait for regarding pipeline decisions?
Yeah, I mean, as Nick said, in April the study is supposed to be complete and presented to the Kenyan government. So, we're kind of hoping sometime second quarter that study would be made public and a decision would be made on the structure going forward. There are cross-border issues and some other issues that land issues, things like that need to be worked through. So, but I think if we can get an announcement by the middle of the year, it puts us well on our path to being able to do FID by the end of the year. And that certainly is important for both the Kenyan and the Ugandan governments, is that we get FID and start the construction of this pipeline as soon as possible, because the pipeline is the rate-limiting factor. We will be able to provide oil into that pipeline the day it shows up at our doorstep. So you're almost working backwards with the field development program from when we expect the pipeline to be completed.
Okay, very good. Thanks a lot.
Thank you. The next question is from Alex Topuzoglu from Exane. Please go ahead.
Hi guys. I have just a couple of questions from me, please. So we've seen Tullow cut back on the exploration, quite heavily. So maybe potential farming partners might be reluctant to farm into your stake and fund your share of activity if the operator then forces activity to slow or stop. So have you considered or already engaged in three-way discussions with Tullow, a potential farming partner, to take a slice of both your stakes? And then, if we start with that one, and then we'll move on to something else.
Yeah, I mean, I can't speak for Tullow, but I know Tullow has publicly stated that they have no interest in farming out any of their interest in either of their East African rift plays. So I would take that as their answer on that issue.
Yeah.
For us, we have had on and off discussions with several companies, several big companies, and most of them are not really focused as much on the exploration side. They're really focused more on the development side. So I think deferring some of our exploration till next year, I don't think really has an impact on partner discussions. I think if anything, giving resource certainty, getting pipeline certainty, getting reservoir certainty, those are the things that are going to push the partnership discussions ahead. So hope that answers your question.
Yeah. Okay, perfect. So then on that, how much more field work do you guys need to do to get to a position to sanction the project? So, if you're going down to one rig or, maybe giving up rigs altogether in H2 and maybe into 2016, will you have done enough drilling or so on, to sanction the project at the end of 2016?
Yeah, I mean, drilling, as Nick said, having one rig around would be desirable. We still are interpreting the 3D, particularly in the northern part of the field around Etom, where we'd seen the Etom-1 well was quite interesting. So, I think we'd have enough between appraisal and kind of in Lokachuar Basin exploration wells. We certainly would have enough good opportunities to keep a rig busy for probably the remainder of this year. But I think there will come a time where drilling is no longer really the key. You don't really want to be once you've got resource certainty to a level that you feel you can project and get the project to sanction. You kind of want to stand down on drilling because you're just pre-investing a lot of dollars that are going to be waiting, 2.5, 3 years on a pipeline. So I think, regardless, we would be looking to, stand down on the drilling next year, just as we did with seismic. Seismic, we've got enough seismic. We've covered the key areas with 3D, and we've shot enough 2D in our exploration blocks to get drilling locations. So. Again, this year we'll be standing down completely. There'll be no seismic in Kenya. There's only one crew working up in Ethiopia on our Rift Basin area block where we're partners with Marathon. So I think regardless, you will see a shift next year from drilling and from operations to more development studies and pipeline studies next year.
Cool. All right. Thanks a lot.
All right.
Thank you.
Maybe one more question.
There are no further questions at this time.
Perfect timing. All right. Well, thanks everyone for joining. Obviously, difficult times, but I think we're fairly well positioned to weather the storm. And the important thing is we've got a world-class, very good project. And if we keep our heads down during these difficult times, but still try to keep building the value proposition, people are going to come back to this sector as soon as oil prices start coming up again. Every time I read about budgets being slashed and rigs being laid down, it makes me feel better and better about long-term oil prices. So, anyway, thanks for attending, and hopefully we'll see oil prices increasing sometime this year, and can get back to being a bit more aggressive, especially on the exploration side. So, thanks very much.
Thank you. The conference call has now ended. Please disconnect your lines at this time. We thank you for your